Yeah, there you
Dude, I really hate. I appreciate the heads up, Bruce, but I really fucking hate technology, bro.
Yeah, it says that it's spending until like 11:55, but we're like 30 minutes past almost.
Okay, can someone verify that we're live? Or
Yeah, I'm checking right now.
bro, I really just need somebody to be in charge of this shit. Like, I'm trying to trade. I do not give a fuck about this streaming shit. I do not give a fuck about this technology. I just want to trade, and I want to give you guys value. All right, you guys really gotta understand how much we put up with to be able to provide the value we do, because this shit is. Oh, there he is,
It's
big
live.
Jerome. Thanks for the heads up, right?
You're live.
All right, good stuff.
Thank you, Bob, and thank you to everyone for being
Verify that
here
we're
today.
live.
It's great
And
to be
fuck
back at the
YouTube.
Economic Club of New York, where I last visited before COVID.
All right, what's up, y'all? Great to see
before
everybody.
our discussion.
Hit the like button
I'll
for me,
take a few
please,
minutes
if you guys are
to
on YouTube.
discuss recent economic data and the outlook for monetary policy. Incoming data over recent months show ongoing progress toward both of our dual mandate goals, maximum employment and stable prices. And I'll start with inflation. By the time we raised rates in March of 2022, it was clear that restoring price stability would require both the unwinding of pandemic-related distortions to supply and demand, and also restrictive monetary policy to cool strong demand and give supply time to catch up. These forces are now working together to bring inflation down. After peaking at 7.1%.
All right, y'all, I'm going to enter this position. And I'm going to start to scale. Do not enter a big position. So split it up. All right. So I'm going to put 1/3 of my position here, and then 2/3 down here. Small position. If we go into drawdown, I don't want to hear none of this. Oh, but bro, I was in drawdown. It should be the first position got to be so small. It's got to be inconsequential. So that way, if you do go into drawdown, you still have some ammo right here on the sidelines. That's how I'm going to be doing it. I'm going to have my foot in the door here. And then just to kind of make things easier, I'll just use this kind of feature right there. Fucking trade. Put a stop loss. $14, $8, $10. Bit of a late entry. Not even a bit. Very late entry.
Down sustainably toward our goal. We cannot yet know how long.
All right, so the blue line is my entry.
Persist or where inflation will settle, overcome.
And this is the prime entry down here.
While the path is likely to be bumpy and to take some time, my colleagues and I are united in our commitment to bring down inflation sustainably to 2%. In the labor market, strong job creation has met a welcome increase in the supply of workers, due both to higher participation and to a rebound of
what the fuck does it say buy limit, bro? Come on.
Levels. Many indicators suggest that while conditions remain tight, the labor market is gradually
that's
cooling.
where it is.
Job openings have moved down well below their highs and are now only modestly above pre-pandemic levels. Quits are back to pre-pandemic levels as well, and the same is true of the wage premium earned by those who change jobs. Surveys of workers and employees
Way too late of
return
an
to
entry.
pre-pandemic
Jesus
levels of
Christ.
tightness, and indicators of wage growth show a gradual decline toward levels that would be consistent with 2% inflation over time. To date, declining inflation has not come at the cost of meaningfully higher unemployment, a highly welcome development, but also a historically unusual one. Healing of supply chains in conjunction with the rebalancing of demand and supply in the labor market has allowed disinflation without substantially weaker economic activity. Indeed, economic growth has consistently surprised to the upside this year, as most recently seen in the strong retail sales data released earlier this week. Forecasters generally expect GDP to come in very strong for the third quarter before cooling off in the fourth quarter and next year. Still, the record suggests that a sustainable return to our 2% inflation goal is likely to require a period of below trend growth and some further softening in labor market conditions. Geopolitical tensions are highly elevated and pose important risks to global economic activity. Of course, our institutional role at the Fed is to monitor these developments for their economic implications, which remain highly uncertain. But I will also say, speaking for myself personally, I found the attack on Israel horrifying, as is the prospect for more loss of innocent lives. Turning to monetary policy, the FOMC has tightened policy substantially over the past 18 months, increasing the federal funds rate by 525 basis points.
His tone is a little positive. Did you guys see that? He doesn't seem stressed. He's got a pretty positive tone about the economy.
The stance of policy is restrictive, meaning that tight policy is putting downward pressure on economic activity and inflation. Given the fast pace of the tightening, there may still be meaningful tightening in the pipeline. My colleagues and I are committed to achieving a stance of policy that is sufficiently restrictive to bring inflation sustainably down 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective. We are attentive to recent data showing the resilience of economic growth and demand for labor. Additional evidence of persistently above trend growth, or that tightness in the labor market is no longer easing, could put further progress on inflation at risk and could warrant further tightening of policy. Along with many other factors, actual and expected changes in the stance of monetary policy affect broader financial conditions, which in turn affect economic.
Inverted head and shoulders at the 8/8. Like, people, this is the single easiest trade of all history and all time. I'm just going to be honest with you guys. The only thing I could say I could have done better is, obviously, my sleep schedule this week has been all off. I really could have showed up on time and entered there, but this really could not have been any easier. And if you miss this, I promise you, do not take the next trade until you look yourself in the mirror and ask yourself why you missed this. This is not a joke. This is not a game. If you're missing trades like this, like, the strategy only gets a little bit more complicated from here. This is really, really one of those moments where, damn. Yeah. Take notes.
Doing too little to
Trust.
allow above target inflation to become entrenched and ultimately require monetary policy to wring more persistent inflation from the economy at a high cost to employment. Doing too much could also do unnecessary harm to the economy. Given the uncertainties and risks, and given how far we've come,
The next
committee
trade.
is proceeding carefully. We will make decisions about the extent of additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. Thank you. I look forward to our conversation, David.
Whoa, 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 whoa. No. What? Come on.
We certainly have.
Oh, there are
very,
questions. There's a discussion
resilient
mode.
economy on our hands. We've got the economy growing strongly. If you think back a year, many forecasts called for the U.S. economy to be in recession this year. Not only has that not happened, growth is now running for this year above its longer run trend. So that's been a surprise, driven largely by consumer spending, driven by a very strong job market with people getting jobs with first high nominal wages. And then as inflation has come down, real wages, which is spurring spending. And we've also had inflation coming down. So, that's it. It really is a story of much.
I'm going to protect my entry, especially the late one, because that's just a ridiculously horrible position.
Less affected by interest rates. It's hard to know precisely, but for example, many companies, any company with bond market access will have termed out its debt, right? And therefore may not be feeling the effects of higher rates. The same may be true of homeowners who have a long-term fixed rate, low rate mortgage, who then are therefore not, because it's not an adjustable rate or a higher rate, they're not feeling that increase in rates. So the economy may be somewhat less susceptible to the effects of rate increases. On the other hand, if you look at interest sensitive spending, these are very much the the places where we expect to see and do see effects. So for example, in
That's so
housing,
stupid. It just closed my
or
trade when I said
the
modify.
housing sector's been
All I said
very
was
affected
protect
by
the
higher
position.
rates. As purchases of durable goods, if you look at surveys, people will not say that it's a good time to buy a car or a house, quite the contrary. So we see policy working through its usual channels. It may just be that rates haven't been high enough for long enough. And again, it's all happening in a context of very strong demand.
We've heard other people speculate maybe the terming out of debt, as you say, both corporate debt and household debt may diminish the effectiveness of rate hikes. Do you have a view on whether that's true? And if it is true, what does it say about monetary policy? Does it mean you have to go farther in the rate hikes, or do you just not have the power to affect it?
So no, I don't think that there's a fundamental shift in the way that interest rates affect the economy. There may be some differences in this cycle because of what I mentioned. As I mentioned, we are seeing the effects where we expect to see them, which is interest sensitive spending and also asset prices to some extent. And the exchange rate, which you're also seeing a strong exchange rate, which is disinflationary. So I don't think there's a fundamental change in the way monetary policy affects the economy. And again, it goes back to just very strong demand. We take the economy as it is. We take fiscal policy and the economy and all the things we don't control. They come to us, and we conduct policy always to achieve maximum employment and stable prices. So we just take what comes. The fact that we have a strong growing economy, a strong growing labor market, and inflation coming down. These are the elements that we want to see that to achieve the outcome we want. It may take more time, but ultimately, this is the kind of thing you would want to see along the path to getting through this.
Yeah, Mo, he did.
How much effect?
But that's not necessarily true. At a first sign of recession, I think that's where the real policies come out.
Are you at the 25% point?
He's just talking his book, like he's always been doing.
So there's no precision in the in our understanding of how long lags are. One thing that has changed in the modern era is that markets now, over the course of the last 30 years, central banks have decided, instead of being secretive, to be very transparent. And what that has meant is that markets move actually well in anticipation, well before.
He's giving out the sauce right now, though.
From policy moves to financial conditions actually happens before the moves now, whereas that was not the case 50 years ago when Milton Friedman, coined the phrase long and variable lags. So, but now you have financial conditions changing, and the question is, how does it affect the economy? The standard channels are asset prices, interest-sensitive spending, and the exchange rate, for example. And we do see that happening, just not as fast as we would like. And I would attribute some of that to just stronger demand. Household savings were turned out to be higher. Household spending has been stronger, and that's by far the largest part of the economy.
In order to conduct monetary policy effectively, do you need at least a hypothesis about how much has already hit the economy? Because it's hard to know how much more you need to do if you don't know how far you've come.
So on lags, I think if you think back, it's been a year since the last 75 basis point hike we did. It was at the November meeting in 2022. The first one was in June, so it's more than a year. So we should be seeing the effects. By the way, they don't all just arrive.
But we're not.
They arrive and then they're thought to peak.
We're not seeing the effects.
So there's a lot of uncertainty around lags. And one of the reasons why we have slowed down.
This is going to be his downfall. This statement right here is going to fuck him up.
Time to work. The truth is, though, you can find academic support for different speeds and duration of lag. So we have to use our.
Bears are stepping in pretty aggressively, but just remember, as long as this zone holds, like we can break through, but the market could close back above. As long as that 14,900 zone holds, this thing still has the potential to push up as a massive swing trade. So don't let a little bit of bearish action, especially this rejection here, kind of talk you out of the directional bias. Keep in mind the higher time frame location, which is a daily support zone. We've had multiple rejections of that zone. We have everything we need here to confirm the buys, except for the short-term price action. So don't let the short-term action be the biggest thing, the determining factor of how you feel about this trade. Instead, just always look at structure and make a decision based on the pragmatic decision of whether or not structure is being supported or not.
It's around 2%.
Or structure is being respected or not.
The standard mainstream view would be a little bit below 2%, but I would just say 2% real growth over time. And what causes growth is growth in hours worked plus growth in productivity. Growth in hours worked is a function of population growth in the long run, and also labor force participation. Many things affect productivity, but if you drop in reasonable standard longer term estimates of hours worked growth and productivity, which is just output per hour productivity growth, you get something around 2%, and that's higher than most other advanced economies.
As you look at it, do you see historical precedents for having a growing economy with high rates over a long period of time? I mean, as you look back, I mean, is it like the late 90s, for example? What analogies do you draw as you try to determine what this might be doing to the economy over the longer term?
So that's really a question about what the level of rates will be going forward, what the neutral level will be, and I think it's very hard to know confidently what the answer to that will be.
That's not good. It's your job to know, Powell.
Some of the reasons why rates were low for the last 25
Jesus.
years were just the aging of the global population and globalization, and so lots.
He's not doing himself a lot of favors. He was doing great with the
Plus,
speech, but these questions he's answering a little bit too candidly.
Rates are lower, and productivity was low. So all of those led to low interest rates. So what has changed with the pandemic? You might see less effects from globalization. Certainly demographics, the aging of the global population has not changed. I mean, this is a discussion we're having on an ongoing basis. It doesn't really affect current policy, but where will rates settle out? What will be a normal rate? So if a typical Fed tightening cycle would leave you at 5 or 6%, and this is in the before the pandemic and before the low inflation period, you would have had Fed rates at 4 or 5% or even higher frequently. Are we going back to that? I really don't know. I wouldn't want to speculate.
He just said 4 or 5% Fed rates for longer. Yeah, not good. Not good.
The effective lower bound is not an issue. We were very concerned about that. Right now, we're very
Moment of truth. We're at that zone.
time of really elevated demand coming out of the pandemic as we reopened with fiscal stimulus and monetary stimulus. We have very strong demand in the United States. Hard to know what the economy will want in the way of interest rates when 5 years from now, when all of the effects of the pandemic are behind us.
You mentioned the long-term equilibrium rate, which you talked about again back in Jackson Hole in August of 2020. Back then you said you thought the sort of consensus had come down. I think it was from like 4.25% to 2.5%. Where is it today?
That's the question.
So I think by any reckoning, long-term interest rates and the neutral interest rate came down steadily over the course of several decades. So where is it today? I don't know.
Yeah, sellers are coming in very aggressively, but we got to be patient to see if it's going to wick back up or if it's going to break. If we break these lows and then we close with a solid candle below the lows, yeah, the sellers will have control for the rest of the session, or it'll consolidate here and just keep chopping up and down for the session.
But do you know in order to conduct monetary policy? I mean, you must have to have at least a theory. I mean, I'm not saying you have to be right about it, but you have to have a hypothesis, don't you? As you look at the data, you have to put the data through some sort of theory.
So we all write down our estimates of the longer run neutral rate every quarter in the summary of economic projections, and that's based on models. It's based on also looking out the window and including lags, thinking how are our current rates affecting the economy. So the evidence of your eyes is that the economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough. You're right, though, but we have models for everything. We have formulas.
All right, we just broke through the 88.6. Yeah, we had a nice rejection here at the 886. Market just closed well below it. At this point, unless we recover back above that 875 level, sellers are going to continue to take this down and liquidate these orders. So I'm still going to be patient. I don't like to make decisions in the middle of the meeting because typically the markets will shake out, kick all the buyers out, and then push. So I'm going to be slightly patient here, but the closure below the 88.6 with this solid candle shows us that sellers are currently in control. So keep that in mind.
What we've been through is in all of the advanced economies around the world was a period where the effective lower bound, the proximity of interest rates, risk-free interest rates to the effective
Sheesh.
lower bound, which is zero or a little bit less, was a big problem for monetary policy. And just rates came down and down and down. And the problem is, if rates are going to be close to zero in good times, then how do you cut? And so have central banks lost the power of their most important tool, which is interest rates? This was a subject of a vast literature in monetary policy research for 20 years. And you know, the most common answer was some kind of a makeup strategy. So you would credibly promise to run inflation a little bit hot and above 2%, and that would anchor inflation at 2% to counter the times when it was below. So that was a very serious problem, which filled books worth of research. Then comes the pandemic, then comes the response to the pandemic, and then comes the pandemic inflation, not just in the United States, but everywhere. The question is that a secular change, or are these factors that brought us to that place, are they still out there waiting to come back? And, you know, books are written on this subject now. You can argue that, and some have argued that effectively the last 20 years before the pandemic were kind of a perfect storm of disinflation. And now that's all gone, and we're going into a more inflationary period that will be characterized by more supply shocks and things like that, and therefore more inflationary pressure. Yeah. So are we going into such a, I don't know. I mean, all I can tell you, I think it's unknowable, and, you know, great theorists and researchers have different views on this. It's not something you can settle in advance. We'll have to see. I think our issue is right now.
I like 14. It was 14,600 instead of 14,700 as the next zone.
Whenever any of us go, particularly institutions, go through tumultuous times, and goodness knows you've been through a tumultuous time, we look back and think, okay, what did we learn? So an after action report. Look at the pandemic and the pandemic inflation. What would you say you learned in terms of macroeconomics, in terms of the economy, from that experience?
So hindsight is always a wonderful thing, right? I think the fair way to judge the actions that were taken is to put yourself in the place of legislators and policy, other, you know, and central bankers around the world. And there was no playbook. You know, we hadn't seen a global economic shutdown. People were thinking that the pandemic might kill a whole lot of people, and that we would.
So at this point, I've kind of accepted that sellers are in control, but what I want to do is wait for this pullback to the zone in order to close. And so I'm going to be a little bit patient with this. Again, just keep that in mind. But for some of my more advanced folks, like all the folks on Zoom, this is the pre-session consolidation. We broke that liquidity. So we broke the Asian liquidity at the market open, and then we started closing below. Now we're at the bottom of that range. So let's see if we get that pullback before it continues to drop. But the fact that we broke the liquidity to the upside shows that sellers are in control here, because otherwise they wouldn't have broken through that zone so aggressively. Now I think that we're going to be breaking through, forming some kind of support, maybe at the 700 first before we come up. But this is a pretty bearish sign here. Just the fact that that's how it opened up.
Other countries who didn't do as much as we did also had substantial inflation problems.
I think my question was just a little bit different. It's not so much.
I'm going to see if I can hedge myself out of this trade by taking an entry at the bottom of the Asian low and catching the retracement up, closing that one in break even, and closing the bottom position in profits to see if I can still come out with a profit, even though obviously we're in some drawdown on the original trade. I would not recommend this. If you are a more advanced trader, if your risk is on point, this is a strategy you guys can start using as a more advanced trader. But hedging yourself out of trades does have some, obviously it's risky. And so just make sure that you guys are understanding the play, which is that we're just trying to hedge out of the original position, not looking to take this thing all the way. So just don't overstay your welcome is the main point.
Inflation are both risks. In fact, right now the risk is still high inflation, but I'm assuming once we get back to 2%, we won't have that. But we've certainly learned that. And events are the possible range of events is so much wider than what we think it is on any.
So the simulator is like finding the average of the positions and just putting it there. On my MT4, I have an entry over here. It says 862 on my MetaTrader. So an entry at 862 and an entry up here, like a pretty early entry, I might say, at 974. So I have an entry at 974 and an entry at 862. 974, 862. Okay. Come on,
Two
Powell.
questions. One is why is it happening? And the other is why does it matter for policy? And so I would say on the why is it happening question, I think it's appropriate to have a little bit of humility. It's always hard to say exactly what's going on with longer term yields, but this is what I think we can say. First, what it's not. It's not apparently about expectations of higher inflation. And it's also not mainly about shorter term policy moves. So Fed funds moves over the next year or two. Really, if you can look at the 2-year, for example, and 2 years moved up a little bit since September, but really the move is in longer run bonds. So it's really happening in term premiums, which is the compensation for holding longer run securities, and not principally a function of the market looking at near term fund rate. I think a few other ideas about, there are many candidate ideas and many people feeling their priors have been confirmed by this event, I'll say as well. But so one would be just that markets and analysts are seeing the resilience of the economy to high interest rates, and they're revising their view about the overall strength of the economy and thinking even longer term this may require higher rates. That could be part of it. You know, there may be a heightened focus on fiscal deficits. That could be part of it. QT could be part of it. Another one you hear very often is the changing correlation between bonds and equities. If we're going forward into, if we are going forward into a,
If you guys see this inversion, every single time we dip below the zero, every time there's some kind of inversion here, it's 1 year before the gray bars represent recessions. It's usually 1 year below the recession. So at 2019, it went under. 2020, there's a recession. 2006, it went under. 2007 hit the recession. 2000, it went under. 2001, we hit a recession. On here, 89, it went under. 1990, we hit a recession. We just went under. In 2024, we're hitting a recession. You guys see how this goes?
financial conditions indexes. The answer so far would be yes, you are. Persistence, it will be a matter of just seeing with our own eyes, but certainly they're coming. If you look at financial conditions indexes, they're showing tightening, and it's a lot because of longer rates. Then the question is it endogenous? And is it just because the market expects us to take things, to take further actions to tighten monetary policy, in which case you have to follow through. But that doesn't seem to be the case. It doesn't seem to be principally about expectations of us doing more. It seems that the other factors are the more prominent ones.
Another question is,
Bottom line, though, that means it probably does over time. It makes sense. It's something that we'll be looking at.
well, that's the question I was asking, is over time. From what you understand right now, do you think this is a temporary phenomenon, or do you think there are structural factors, whatever they are, and we can talk about what they might be, that would really, this is the future that we're looking at now?
So of the factors I just listed, some of them are shorter term, some of them are longer term, and some of them could be either. So for example, concerns over fiscal deficits, that could be a longer term factor. The change in correlations between stocks and bonds could be a longer. I don't think we know. I think, basically bond prices are set by supply and demand. The supply of treasuries is a known thing, but demand can be affected by any and all of these theories, and also just by sentiment too, which is hard to characterize. So, markets have been volatile. They've been longer. You've seen the rates moving up and down a lot. I think we have to let this play out and watch it. But for now, it looks. It's clearly a tightening in financial conditions, and so we'll be watching it carefully.
Talking about the fiscal side, and you've been very careful repeatedly to say you want to stay in your lane. You're not responsible for fiscal issues. At the same time, you have to take into account. And it looks like the United States is going to have to borrow a fair amount of money. By the way, other countries are as well around the world. We have a big supply of treasuries coming on board. To what extent do you think that is a longer term issue? And let me tie it back to something you referred to in your remarks, actually. When we see geopolitical conflict around the world, like in Israel, like in Ukraine, some of the buildup with respect to China, the defense spending is going to be elevated for the United States and for other countries. Do you take that into account in figuring monetary policy? Because it may well mean that we're borrowing a lot more money than we have in the past.
So we, of course, see the same things that everyone else. So I just came back from IMF meetings.
So ultimately, inflation has been coming down since the beginning of this year. So inflation was climbing from 2021. We kind of peaked in the summer of last year. And that this is a core CPI. So this is basically all consumer price goods except for food and energy. And food and energy do make up a considerable amount of everyone's budgets, but this is for all other goods. You guys can see that, throughout this year, we have seen a considerable downtick in overall inflation. So something about what the Fed is doing is working, despite how the market may feel about it. Labor, I'm going to show you guys the unemployment rate here in a second, which is still historically low. So like the economy is doing good.
Is sustainable, and we'll have to get off that path sooner rather than later.
Okay, the position I entered at 62 is in profit. And so I'm just going to wait for this thing to push up slightly. I'm kind of looking at this 14,921 here. And so we just push up, and then I'll be able to close both my entry. Ideally, I'll be able to close this situation in profits. Where the bottom position is running in profit, I can close the top position and just a little bit of drawdown, and they'll cancel each other out. So plan for that one. When you're hedging, you're not throwing two positions. So if you're going to risk $1,000, like you would have risked $300 on the first trade, and now you're risking $700 on the next trade, or you would have risked $500. But you're not throwing $1,000 risk and then another $1,000 risk. That's over leveraging, because that way, if the trade loses, you're going to be in a world of hurt. This way, if I lose the trade, it's the same as if I had thrown a complete position size the first time. Except now I have a much better entry and I can at least hedge myself out. I hope that makes sense. Okay, so we're getting that rejection here. And 14,921. Again, do not overstay your welcome. This thing is likely to reject that zone and it could crash. Or it could break above. We don't know. But that's the thing about hedging. It's about risk management. It's not about maximizing the profits.
And that's how we think about it.
I'm curious though, one of the things
CA members, did anybody take the hedge position or no? Because this thing is right next to I'm about to be in break even here on both positions. So what I could do is reduce my risk by cutting that position and cutting that position down. There it is, back in profits. On my MT4, I'm in deep profits.
it's almost zero, and business changes an awful lot when you really.
Because I put the bottom position is larger. So what I'm going to do is I'm actually going to close half of the bottom position and close the full early position, because now they're both in, like they'll cancel each other out. And I'm just going to hold this 18 or this 14,862 position on my MetaTrader. I'm going to hold that one and put it in break even and see if I can ride this thing up. I'm going to take partials or take TP1 at the 61, TP2, and then TP3. All right. So I'm doing that right now, just as a heads up. Oh.
Volume's not going up very much, but companies are profitable. You don't, now if you get to where I think the cost of capital would really matter would be for smaller companies and early stage companies, and that really does matter. So we don't have a lot of tools. We have interest rates, and they're far from perfect. It's famously a blunt tool, but it's what we have to get inflation down, and really the world counts on us to deliver.
Okay. Perfect TP1 right here. Perfect TP1. Now I'm moving my stop loss to break even on my MetaTrader. There's a little bit of a lag of what I'm doing here on the simulator because I'm doing it on my phone first for my real account. So give me a sec while I update this. But move your stops to break even on that bottom position if you did hedge. Check the comments here. Bryce said I just pulled it. I took one at 14,841. Took it from the bottom. I waited. James, good for you, brother. Love to see it. TP1 got hit though. Don't overstay your welcome. Take your partials and make sure that you're bagging those wins. For some reason, it's still showing my early position up here. So if you guys can just imagine, my position is right here on my MetaTrader.
You did it again today, 2%. No question about it. There are those who suggested, including some colleagues in the Fed, that maybe the bond market is doing part of your job for you. Is that the way you see it?
Look, I would say it this way. The whole idea of tightening policy is to affect financial conditions. And to the extent higher bond rates reflect that they're producing tighter financial conditions right now. So that's how monetary policy works. That's literally how it works. So again, in principle, as long as bond rates are going up for some reasons, and they're not going up just because they expect us to do things, so that if we don't do them, they'll come right back down. And we don't think that's the case, actually. I don't think it's the case. It doesn't seem to me that's where analysis leads you. Then sure, that's a tightening. That's exactly what we're trying to achieve.
And therefore, it seems like almost arithmetic. It must reduce some of the impetus for you to continue to raise rates.
At the margin, it could. I mean, I think that remains to be seen. And by the way, I'm not blessing any particular level of longer term rates, but just in principle, that's right.
So let's talk about the labor market. You referred to that in your remarks as well. And as you say, vacancies have come down some.
On my account, the stop loss is above break even. So it's actually sitting right here. So that's where I'm going to put it on this on the simulator. But did this thing just close me out of my trade? Yo, yeah, this simulator sucks. All right, that's why we're partnering with FX Replay for the trading simulators.
Revenge travel and revenge everything. Very strong.
But I hope that this made sense in terms of the hedging. I hope that the TP1 starts to make sense to you guys. There's a good chance that this thing does flip. You just got to be patient about it.
Close to that.
It's a beautiful rejection here.
That, and wages and bonuses, and particularly in things like in person.
So now I'm holding a lower position. We got a beautiful rejection. It's in break even. And if this thing does push up like the original trade idea that we had, we're going to be taking this thing up to TP1, TP2, and then TP3. All right. So a lot of potential in this trade if we do get a continuation of this rejection.
And that measure was no, but now it's back to pre-pandemic levels. You survey workers, are jobs plentiful? And that was at an all-time high, and now it's still high, but back. So wage increases are coming back down to more normal levels. Job openings are down from 2 to 1.
For my CA members and some of the folks from the NASDAQ boot camp, we're now closing back above that 14,912. So we're back above that zone. That's good. This is a good sign. You want to be above that zone. Now, don't overstay your welcome. Make sure you guys are using proper risk management, because obviously there's tons of volatility here. And so whenever the market creates this range during news like this, you'll typically just see price play in between this range all day. But if we really think about it, we have this consolidation here, fake up, fake down below the zone. And now I believe we can get that continuation to the upside. Okay, there's volatility, but price may just get trapped inside of this range for a little bit, do a bigger expansion, a bigger contraction, but just be mindful of these areas, guys. Be mindful of these areas. And then there's a top wick and a bottom wick. We have the low and the high of New York for the day. And so just make sure that you are keeping that into account. We're right in the middle. So if you're taking buy entries here, you're not buying at the greatest price. The greatest price was down here. If you want to sell or you want to take profits, this is going to be the best area to do so. Good. Oh, that's clear.
Inflation of the 70s, it was a very tight relationship. And that relationships went down and down and down to the effect where the Phillips curve, there was almost no relationship, meaning the Phillips curve was very, very flat. Now, actually, if you just ignore cause and just look at the data, it will tell you that the relationship is back. Do we really think that's a sustainable thing? I don't know. What happened though was that people came to seriously expect 2% inflation, something like 2% inflation. And if people expect that, if companies expect it and workers expect it and you expect that in your shopping, then that's what'll happen in a way. And that's what happened. So even in very, very tight labor markets, we didn't have high inflation. I was at the Fed since 2012 as unemployment went from 6 to 5 to 4 into the 3s for the first time. And, the models were all saying that we should be seeing some inflation, and we never really saw 2% inflation on a sustained basis during that era. So we learned that the Phillips curve was really.
And that's how you get the Hoek entry. Come on now. I'm not even reading these comments today.
We're seeing it all.
Let me read the comments real quick. Will you enter again? Smart money going to sell it. Those buys are a retracement. Support doesn't exist. Bro, don't buy that shit. Yeah. Yeah, Money Max, hold these. He trying to get a solid answer out of Powell. Yeah, bro, Powell's dodging. Good morning, everyone. Digital era elevation. What's going on? Why is your bias bullish? Because I'm built like that Tommy Sotomayor's mama. If that was your own money, you don't have, you would have closed long ago. No, I would not have. Marshall Matters. Don't tell me what I would or wouldn't do. I'm risking. You guys got to show up early and understand what I'm doing. Okay, just for everybody, I am not live. This is not live trading on the simulator. I'm live trading on my phone. Okay, I don't want to pull up my MetaTrader anymore. I'm trying to respect my own privacy, but I'm literally doing the same actions on the simulator as I'm doing on my phone. Chart Addicts members know I'm going to post my MT4 results because I love to flex. Okay, and so y'all just take it easy and just take it easy. Where are the sells, boys? Sky Blue talking that shit. Always appreciate that support. Can this be viewed as a fake out 1 and 2? Brian Tang, my guy. And then now the true move, big Brian. Talk that shit. Bryce says Roy 100 back at it. I never left, baby. A bunch of the haters in here. Yes, hold these. Big Adam said, bro, these comments are hilarious. Fam, I'm telling you right now, betting against me is not a good move. But if you want to do it, go help yourself. Said, look at these rookies in the chat. Josh, you know they just showed up, bro. Some guy comes in, it's like, no, Roy. I mean, it's okay. You just know they ain't been here long enough. Said she's about to fly. Oh, it already flew. It already flew. You guys, the whole point of this hedge entry is, at first we had a 1.5 to 1 R on that trade, depending on your entry. Actually, over here it was 842, I'm pretty sure is where I entered. There's a 20-point lag between this chart in front of me and the chart that I'm looking at on MT4. So 20-point difference. 862 would actually be 842 on this chart. This thing was a 2.7 to 1 R. All right. And it's in break even. So this was the trade. Like there's 111 points here. Well, what more do you need? All right. But then if it does continue to push, yeah, that's where you get those high RR trades. The original entry would have been 2.6 R for the full thing. And just for what we're floating, it would have been a 0.4 to 1. So that's why the original entry at the 88, like that's the, you know, that one's, I always go light on for a reason, because you're going to get this violation. And I always tell you guys, especially my advanced coaching folks and the folks on the NASDAQ bootcamp, if you go back and really pay attention to the videos, I say all my best entries are below the 88.6 because that's where the R&R goes crazy. Okay. So hopefully that makes sense. And if it does not, we're hosting another NASDAQ masterclass November 5th through the 8th. If you guys want to learn this strategy in depth and really understand how to trade NAS and understand it at a much more sophisticated level, head on over to chartaddictsfx.com. Quick reminder, go to live classes and you guys can register there. It's only $350 to learn the strategy. I believe in you guys. If you're hungry, motivated, and you know how to learn for yourself, make sure to go ahead and click that link. It'll be very beneficial.
You know, as presenting much broader problems, but our job is to make sure that it doesn't.
As you mentioned, regional banks are where a lot of people focus on this. As you conceptualize the banking system, what is the role of the regional banks? We have the super big banks that don't look like they're going anywhere. And we've got the community.
So we need to petition to change the name of NAS 100 to Roy 100. People, I'm just a vessel, okay? I need to remind you guys, I talk a lot of shit because honestly, it's fun and that fake humility is kind of whack. But on a real note, like, do not attribute this credit to me. Did I put in the time? Fuck yes. Can you do the same? Yes. But your job is to take advantage of this information I'm giving you, especially the folks that did the bootcamp. I need you guys to take advantage of that information. You got to stand on my shoulders of all the knowledge and wisdom I've put together up until this point, so you can make it better and better for yourself. You guys, your starting line is all the work I've put in up until this point. You have an obligation to beat me. What a lot of these guys are doing is like, they're trying to be the center of attention. As I'm just a humble piece of this debt. Well, we're fucking irrelevant in these markets. I'm gonna just let you guys know, I could be trading $100 million account and still would not budge in this market. So your job is to take this information, use this as your starting line, build on it as much as you can, make the strategy yours, and then you guys will be the next generation. But really, guys, do not waste money and time trying to, like, you know, beat the markets or any of that bullshit. All right. So one, I'm not trying to take all the credit, even though I did put in the work. Two, just learn this shit, learn the strategy for yourself, and just learn to recreate the success. It's kind of like learning a magic trick. Once knowledge is the biggest equalizer. All right. When you guys don't know what's going on here, it kind of seems like magic for a while. The Chart Addicts members that are watching, you guys know this is mastery. This is not magic. This is years of experience. This is just no hesitation, really believing in yourself and trusting the strategy, not just the original entry, but some of these more advanced things like hedging. All right. Jerome Powell's speech just ended. Let's see if we get that relief bounce up. Either way, take partial profits as necessary. The next zone to watch is the 15,000 level flat. I'm actually going to rewind this and watch back probably the last hour, or sorry, the last 10 minutes, because I was talking over it. I just want to see what his final remarks are to see if it's positive or negative.
Very strong, well-capitalized banking system that's much better at managing its risks than the one that entered the global financial crisis.
Very well capitalized, but you want some more. This is
You're
a
talking about the
proposal.
Basel III proposal, which is, you know, it's a rule that's out for comment, so there's not a lot I can say, but we do expect a lot of comment, and we do expect to take those comments very seriously.
Talk about the commercial real estate. There are some concerns out there in the marketplace, what's going on, because obviously there's a repricing that comes with your increased rates. It's thought that there's some real estate out there that is not worth the money that was originally financed with it. How concerned should we be about that as something lurking out there that could really affect the system overall, not just the people invested?
So there's work from home, and that's affecting downtown real estate in a lot of big cities, and higher rates as well, as you point out. So this is an issue that we pay a great deal of very careful attention to. Commercial real estate is not a principal risk or a major risk for the very largest banks. It is much more for regional, and really the smaller banks have proportionally a much larger exposure to real estate, so commercial real estate. So what we've done is supervisors are in there looking at real estate portfolios. They're working with banks to make sure that they have plans to deal with the problems they have in their portfolio. These problems evolve over time. They don't land with great suddenness like a market event. And so we're working with all of the bank regulators are working with banks that have, you know, concentrations of troubled real estate to work it out. There will be losses for sure. You can drive down through most downtowns, in many downtowns anyway, and see buildings that are empty and things like that. But we're working through it, and you know, we're on that case, and don't see it as you know, as presenting much broader problems, but our job is to make sure that it doesn't.
As you mentioned, regional banks, there were a lot of people focused on that.
Yeah, if you guys learned something or made money on the stream today, make sure to drop a like. Make sure to just drop a like. Subscribe if you haven't. Welcome. If this is your first time, if it's not your first time, welcome back. It's always great to see you all. Y'all know the drill. I'm going to be here as often as possible. I'll be traveling to Dubai this week to go tour some venues for the FX Summit 2024 conference. If you guys don't know, we host the #1 trading conference in the world. Thousands of traders from around the world come every year to the FX Summit 2024 conference. Next year, it's going to be in Dubai. You have until November 2024. That's 13 months to plan for this trip, to try to make it out here, to meet some of the best traders in the world, to learn from some of the greatest minds. We're going to have a lineup that will absolutely blow your mind. Every year gets better and better. This year is going to be no different. Love to see all of you guys out there, but I won't be streaming tomorrow because I'll be traveling. Actually, I'm not traveling till 5, so I will stream tomorrow. And I'll try my best to stream from Dubai while I'm out there. But for the 2-3 days I'm traveling, I probably won't have time or internet access. So just a heads up. So I'll be here as often as possible. You guys know how we do it. If you're interested in learning the strategy for yourself, we're hosting another NAS 100 master class November 5th through the 8th. I believe there's 2 days left to register. I think there's only 2 days left to register. Okay, so make sure that you guys take advantage of this. If you're in a different time zone and you can't make these class sessions, the recordings will be available to you, and you'll still be able to go through the quizzes and the final exam and get your certificate either way. All right, you got to go. Take it easy. I'm still on here for a little bit watching this trade play out. And then also give me one thing that you guys learned on the stream. Drop one comment in the comments section. What's one thing you guys took away? Same with CA members. Don't skip out on this.
All I want to do is do the best job I can for the public that we all serve. And yes, there's a lot that is enjoyable about it, but mostly it's just so important to get it right, and that's what we're trying to do.
Thank you so much, Chair Powell.
Really good. Thanks a lot. Thanks.
Well, let me just conclude with 4 thank yous. First, thanks to the team from the Economic Club that organizes these events. It doesn't happen because anyone on the dais does anything. It happens because the team works hard and organizes it and makes it go so smoothly. Number 2, thanks for our audience, both and our members, both here in the room and online. Let me also say thanks to David. You did a great job engaging with the chairman. And, you know, I think I saved the best for last. Jay, thank you very much for your talk today. Thank you for the time speaking with David. And all of us say,
Where's that tab?
very much when you read and listen to your contribution to the Fed in your various roles, there's only one thing to say, and that is thank you very, very much for your service. Thank you. Everyone enjoy lunch.
Said everyone enjoy lunch. Love it. So I completely lost that tab. I'm trying to, sorry guys, I'm trying to find this tab with the video playing so I can pause it. Oh, there it is. Okay. Ready to get back to it. All right, everybody. How we living? I'm getting a call from QB Stu. Yo, look at this bounce. Yo, look at this bounce. Oh, come on. All right, guys, give me 1 second. Let me answer this phone call. Yeah, I think that's too funny, bro. I mean, it's something else. Okay. Let me show you guys something called a fractal. Fractals are basically where you have like a big thing. And then inside of that big thing, so I know I tell you guys to buy at the bottom, sell the top of the big ranges. And then as price makes it down here, you're going to have mini boxes inside of that big box. You want to buy at the bottom, sell the top of the box. You guys get the drill. Inside of that little box, you're going to have little mini boxes. So the fractal is just kind of just something that continues, like it's inside of a thing that's inside of a thing. Okay. Let's go through this fractal right here, where we have the big kind of pattern here, where you have like the consolidation, fake up, fake, okay. But then inside of that pre-news, we also have this. We faked up, faked down, and then we pushed. You're targeting the equal highs. If you break the equal highs, then you look for a pullback, top of that range, and keep the show rolling. It's a fact. It's inside of the. It's a thing inside of the thing. All right. I'm not going to go into too much detail, but you guys get the gist. My CA members, you guys get the gist. All right. If we look at this on a bigger scale, let's do pre-session consolidation, or let's do Tokyo, Frankfurt right here. All right, so we actually had 3 different violations. We had 1, we had 2, and then we had another one right here. Oh, no, we had 4 violations. That's kind of ridiculous, if I'll be honest. That's a real shakeout. All right, so then let's move this. So the first violation here would be to the upside. Second violation would be to the downside. And then now we're starting to break above that zone. So I think as long as we break above this whole level, you got to pull back and continue. What's the exact price? Body to wick. 14,932. You're welcome. 14,932 re-entries. Thank me later. Okay, that's all I got for you guys. I'm gonna catch you tomorrow. If you guys enjoyed this stream, again, please drop a like. Would greatly appreciate it because I know it's going to help boost the video. More people can learn and we can start to grow this thing. Appreciate all of you guys coming along. Looking forward to having tens of thousands of people on these streams every morning, showing off this strategy, letting everybody make money. And then obviously we want everyone to be self-sufficient as a trader, because if you're not self-sufficient, then you're dependent on someone else to eat. And you cannot do that. You guys know that I'm not that consistent. Sometimes I do streams, sometimes I don't. I'm human and I got a life. Okay. So learn the strategy for yourself so your family's future can be in your hands and not the hands of this very entertaining guy and very informed and skilled trader on YouTube. But instead, you have now the power to take care of yourself. So take it easy, happy and safe trading for the rest of the week. Peace. And again, live classes, chartaddictsfx.com, NAS 100 Masterclass, November 5th to the 8th. Can't miss it. See you there. But end that stream.